Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world so you don't have to. And let me tell you, this report from Atlantic Union Bankshares Corporation has some big moves and even bigger numbers to unpack. We are looking at their annual report for the year ended the 31st of December 2025, and this bank is clearly playing the merger and acquisition game, grabbing up other banks to grow. They bought American National last year, and just recently, on the 1st of April 2025, they swallowed up Sandy Spring Bancorp. That's a huge part of why their assets jumped so much. Let's talk numbers. At the end of 2025, Atlantic Union Bankshares had over $37 billion in total assets. That's a massive increase of almost 53% from the year before. Most of that growth comes from that Sandy Spring acquisition. Their loans held for investment also surged by 50% to nearly $28 billion, which is directly tied to these acquisitions and some organic growth. Financially, things look solid on the surface. Their net income for 2025 was over $261 million, which is a pretty good jump from $197 million the year before. They are earning more money, but a lot of that is due to the sheer scale of these new acquisitions rather than just organic improvements. They're calling their adjusted operating earnings something to look at, excluding all sorts of one-off costs like merger expenses and initial provisions for expected loan losses. For 2025, these adjusted earnings were a whopping $444 million, a big leap from $252 million the prior year. What does this tell us? They are trying to show a consistent underlying profitability by stripping out the costs associated with growing so fast. Deposits are up by nearly 50% to over $30 billion again, largely thanks to Sandy Spring coming aboard. This is good because deposits are a pretty stable and cheap way for banks to fund their operations. They are saying that about 151% of their uninsured deposits are covered by other liquidity sources. That's reassuring in today's banking climate where people get nervous about their money. Now, expenses are also way up almost 77% to nearly $900 million. A big chunk of that is salaries and benefits, which makes sense with a much larger workforce after the mergers. Merger-related costs are also a massive line item, over $157 million for 2025 alone, which shows you the real cost of these big deals. Looking at their different business parts, wholesale banking, which handles loans, leasing, and other services for bigger clients, brought in $584 million in net interest income. That part of the business grew significantly, it seems by over 54%. Consumer banking, on the other hand, saw its income before taxes drop by about 26%. This could be a concern. They are saying it's due to higher expenses and credit loss provisions in that segment. It's important for banks to have a healthy consumer side, so this dip needs watching. Asset quality is a key thing to watch for any bank. Their non-performing assets as a percentage of total loans held for investment remain relatively low at 0.42%, which is up slightly from the year before. They had some issues with acquired loans from Sandy Spring pushing up non-accruals, but overall it seems under control. Their net charge offs, though, did jump significantly to $42.5 million from about $8.8 million the previous year. That's a big increase, and they are blaming it mainly on two commercial and industrial loans. This is a red flag to monitor. Their investment portfolio is noteworthy. They hold over $4 billion in available for sale securities, which are recorded at fair value. These have seen a big chunk of their value tied up in unrealized losses close to $300 million. While not actual losses yet, it shows how market volatility can impact a bank's balance sheet. They are saying these are mostly due to changes in interest rates, not credit quality, which is a bit more comforting. One interesting detail buried in here is about something called forward sale agreements. Back in October 2024, they entered into these agreements to sell over 11 million shares of their common stock. Then on the 1st of April 2025, they actually delivered those shares, receiving about $385 million. This was likely done to help fund the Sandy Spring acquisition. It's a way for companies to raise capital in advance. Now let us look at the risks. This section is long and detailed because banks are complex operations. They are worried about things like their allowance for credit losses not being enough to cover future loan defaults. That's a standard concern for banks, especially in uncertain economic times. They specifically mention risks from commercial real estate loans, which are a big part of their portfolio. They recognize that sector is getting more scrutiny from regulators. They also highlight cybersecurity risks, which is a huge deal for any financial institution today. A breach could mean big financial and reputational damage. Everything from interest rate changes to economic downturns to unexpected weather events are listed as potential problems. They are acknowledging a lot of external factors can impact their business, which is good transparency. The report spells out their strategies for managing these risks, but as always, there is no guarantee they will work. Looking at liquidity, they seem to have a good handle on it. Their core deposit base is strong and growing. They also have access to backup funding from places like the Federal Home Loan Bank and the Federal Reserve discount window. They even sold off a bunch of commercial real estate loans back in June 2025, worth about $2 billion. Which generated over $1.8 billion and helped free up cash. They are using appraisals to value property used as collateral for loans. This is a standard practice, but they acknowledge appraisals are estimates and can be wrong. This is a crucial point because the real value of collateral can differ quite a bit from what an appraiser says, especially in a down market. So what is the story here? Atlantic Union Bankshares is aggressively pursuing growth through acquisitions. They've doubled down on this strategy, which has led to massive balance sheet growth. The financials show a company that is profitable and growing, but you have to look closely to see how much of that is from savvy organic growth versus just buying other companies. The risks are clearly laid out and they seem to be managing them, but the market is always unpredictable. The increased expenses and provisions tied to these acquisitions are a drag on current profits, but the hope is that the long-term synergies and market expansion will make it all worthwhile. It is a bold strategy and time will tell if it pays off or if they just took on too much too fast. Alright, that is our deep dive into Atlantic Union Bankshares Corporation's latest filing. What is your take on their growth strategy and these numbers? Let me know in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate deconstructions. And hey, if you want to connect with other finance enthusiasts and get more exclusive content, check out our Discord server linked in the description. Thanks for watching and we will see you next time.